Okay, and then there we go. Okay, let me bring this down. That didn't work. Okay. There we go. I'm going to try to share screen again. When I shared the screen a minute ago, I lost the chat box. So I'm going to try it from this way. Okay, I'm going to have to, I'm doing the chat box or the show screen, and I'm not seeing the chat box. So I will see what happens. And if nothing pops up, I will just, I guess, unshow the screen in a few minutes and see if you have a question. So I'll just go through this. Because I will be honest, I haven't had anyone attend this session since we've switched to Zoom in the last, I guess, 4 classes. But they have been classes with only like 2 other learners, so it's still a learning curve. So I'll just go ahead and go through this exercise, and then I'll stop sharing the screen to see if you have a question. The first exercise is going through cost, volume, profit analysis, and then also determining the break-even point. So this exercise, we had an example with the first case scenario was the selling price per unit was $250. Variable costs per unit was $150. Our monthly fixed costs for this scenario or for this company is $50,000. And we're anticipating, or we're budgeting on selling 700 units. So for this model, we're going to say we're going to sell with the 700 units at $250. That's sales price of sales dollars $175,000, and then your variable costs, which are $150,000 or $150 times your 700 units, is $105,000. So that's your contribution margin of $70,000. If you recall in your text, your contribution margin is your sales dollars less your variable costs. So we have a contribution margin of $70,000. Then from that, if you take out your fixed costs, which we were told were $50,000, that leaves us with the operating profit, which is contribution margin less your fixed costs. The operating profit was $20,000. So in this scenario, our contribution margin per unit, which was, we knew our contribution margin of $70,000, and we sold 700 units. So our contribution margin is $100 per unit. And in this scenario, we were not asked, but I just wanted to show, because it is asked in many occasions, what our contribution margin ratio is. And to calculate that, you take your contribution margin divided by sales. Well, our contribution margin was $70,000, and our sales was $175,000. So we get 40%. Now, besides calculating what our contribution margin per unit was, we also wanted to determine what our break-even point. What is the minimum number of units that we could sell to just break even in this situation? That would be 500, because To break even, we have to know how many units do we have to sell to cover the fixed costs. That would be the contribution margin per unit. Divide that into your fixed costs. So divide the 700,000 by $100. So that's 500 units. Now, they just gave us some other scenarios. If we increase the price by 10%, so now it's $275, we remain left the variable cost the same, fixed cost the same, number of units, then what would our break-even point be? And so in this case, it went down to 400 because with those changes, because our sales price went up, but our costs remained the same, you can see our contribution margin went up to 87,500, which means our contribution margin per unit went up to 125. Now, one thing to notice when I'm going through the calculations, that in this scenario, fixed costs went down 30%, variable costs went up 10%. I went through the calculations and I came up with the break-even point is 411.76. Mathematically, in what we've learned, we've always, and even in money, you say 411.76, you round up. So we just say 412. But we need to remember we're saying how many units would we have to sell to break even? And actually, I wrote this backwards. To break even, it would be 412 because if we sold 411, that wouldn't be quite enough. And rounding 411.76, you would round that to 412. So that would be the correct answer. So I just need to change that note. I'm sorry. I was thinking of something else. But had the answer been 411.34 and we wanted to round down, that would not be correct because we couldn't sell 411 and break even. So even though it was 0.3, if it were 0.34, you would still have to round that up to the 412 because we can't sell a portion of a unit and the 411 wouldn't have been enough. So that partial unit would have to actually be sold as a whole unit to make that break-even point. And I hope that made sense since my note there wasn't right. So I'm gonna go and unshare this for a moment so I can see if you had any questions since I didn't walk through each one of these scenarios. If walking through the base case scenario wasn't enough and you'd like to walk through the other scenarios to reinforce the concept, I can. I just don't want to take the time up if you have this down. So since I can't see comments, I'm going to unshare this real quick. Okay. And I thought maybe with your experience and having some experience in that area, it would help. You probably had it, but I don't like to make assumptions. Okay, where did it go? There. Okay, the next example I'm going to cover was the make or buy decision. This example is, companies are presented with this all the time. Whether do we make the product in-house, whether it's the whole product, or do we make all the components in-house? Do we sub out some of them? And then sometimes do we sub out the whole thing and then just slap our name on it. So, and I'm sure you're aware of that just from, consumer point of view, that nowadays we're seeing that all the time. Some products, there's one manufacturer, but it has 2 or 3 companies slapping their brand name on it because they found that one manufacturer can make it cheaper than anyone else. So why, they can buy it from that manufacturer, then put their label on it and sell it cheaper than they could make it, even though they were making it for 100 years themselves. So this is an example of a company facing that situation. Top of it, the scenario is a company called Best Boards. They produce wakeboards for $110, but they received a bid for $70 per board from an outside manufacturer. So should they continue to produce the wakeboards in-house or purchase them from the outside supplier? What information do they need other than to identify fixed costs and variable costs to make that decision? So key facts that they need to know would be all the variable production costs would be eliminated if Best Boards buys the wakeboards rather than making them. Then the factory equipment lease, that will continue for several years whether Best Boards makes or buys the wakeboards. So that would be a true fixed cost. They still have to continue paying on the equipment. The factory building lease, that covers several years as well. So that would continue whether they buy or make the wakeboards. Then one of the Best Boards 2 production supervisors was hired recently and paid $50,000. And that person could be let go if needed. These are just hard, cold facts, so we're not going to go into the not soft skill, but into the ethical and those types of decisions. This is the whole monetary side right now. So, and in some cases, as we go on in this textbook, and this is a textbook I haven't taught from this edition, but I have seen this exercise reworded in that the supervisor could be moved to another team. So you just have to watch and read these carefully so that, and it's real life as well. Sometimes you can keep people on, or the equipment could be moved to be used. They could increase production somewhere else. So these scenarios aren't always the same, real life or exercise. You just have to be aware, and also if it's real life, think about the possibilities. You think of something being a fixed cost that you're just going to blow away, or but it could be a fixed cost but move to a different production line. So in this scenario, we had the variable production costs. If we're making them in-house, the direct materials are $30 per unit, so we have $300,000. Direct labor, $16 per unit, so $160,000. Manufacturing overhead, $10 per unit, so $100,000. But the other variable cost is if we're purchasing finished goods, it was going to be $700,000. So looking at those expenses, the difference would be if we purchase them, it's $700,000. Lower to if we bought, but the expenses were higher to make in-house, higher than if we bought them. And then checking to see, no, still won't let me see any comments. So then our fixed production costs, our equipment lease, and our building rent, which can't be changed. So it's $110,000 and then $290,000, and those are unchanged. Then our supervisor salaries, we had $140,000, but if we buy, it could go down to $90,000. So the difference is $50,000. So to make in-house, it's actually higher. So if we look at the difference, total production cost to make them in-house is $1.1 million. To buy them is $190,000. So the difference is $90,000. So it is lower to manufacture those in a house. So the decision would be to continue to make those in the house because we're actually doing it for $90,000 less, even though we have to continue to pay like $400,000. We have $400,000 in equipment leases, and well, this would be wise because we have $400,000 in equipment lease building rent. So that's why why it's lower to continue to make them in-house. If these perhaps weren't so high, then it would be cheaper. If we could get them to go down on their price, then it might be cheaper to go the other route and buy them, and then look at different ways to use the equipment. But in this case scenario, the company would need to continue to make them in-house. So, does that make sense on that? There could be a case with the equipment lease that you could have an option that you could return the equipment, especially if that equipment was only being used to produce those wakeboards. Let's say the company produced wakeboards and trying to think, swim fins. I'm just gonna throw out wild guesses. And so that equipment was only used for those wakeboards, and the scenario was that they could return that equipment. Now, in those cases, sometimes there's a penalty for canceling the lease, and that would be factored in there. There would have been another line in there under fixed costs, and there could be, that cost in there. That would be figured in there, and it might be still a benefit to then, if you cancel the lease, and let's say there's $100,000 penalty for canceling the lease, but then you're not paying that $290,000 for another 12 months, that would be a benefit because they were only saving $90,000 a month to do that. And then again, like with building rent, depending on the area, especially if it was a highly sought out area for people trying to rent, and they knew that, so they could call their landlord and say, hey, we don't need this much space. Do you want to can we get out of our lease? We only want half the building now. Can you rent out the other half? And especially in those scenarios, sometimes you don't even have to pay a penalty if they've got someone waiting But if they don't, then again, they might be able to renegotiate their lease and maybe a penalty. Just like if we own or renting a house and we want to get out of a lease, sometimes we lose our deposit or something. But in those scenarios, it would you could have that situation. But again, depending on the type of equipment, type of building, or type of business, variety of product lines, if the equipment and the product lines are compatible, they may have been able to sell out those wakeboards and expand their surfboard line. And so they're now using that equipment for their surfboard lines, and the surfboard would then take over that $290,000 in fixed costs to the surfboards. Now, it gets to be a more complicated equation because they didn't have to do two equations. They have to calculate what the surfboard costs are now, and is that increase worth taking on, and sell, because now they have more capability and capacity to produce more surfboards, and are they going to be able to sell that increased number and determine that. And so if that's possible, if they can do that, then okay, then it's feasible. If that's feasible, then do that and then sub out those wakeboards. So there's a lot of variables. Then there's also, sometimes if it comes down to that was 90,000 difference, which over a year's time, that's not a lot. If you're looking at that as a month's time, that makes a big difference. If it was over a year's time, then they need to look at, okay, if over a year's time we're just losing 90,000, but yet we have all these people we're responsible for, and this is the cold hard corporate looking at it, cold hard facts. We're saving $90,000, but over the year, we're responsible for, I'm just going to say, these 15 employees, we're responsible for any accidents they have. We're carrying their health insurance. They're part of our group. If they're looking at, okay, these 5 people in that area, they're adding to our health insurance, whether right or wrong. If this is a smaller company, they know this information. Okay, those 5 people are adding to our health insurance costs. These 15 people are in our workers' compensation group, and that equipment line is kind of dangerous to use. Maybe it's worth giving up that $90,000 to not have those products being made in our building anymore. And then we don't have that workers' comp risk of those 15, because of those 15 people here, and because of that production line. And we get rid of those 5 people whose health's kind of getting bad. I'm not saying that's right. I'm just saying those are decisions that are made. And then if it comes down to, sometimes it's not make versus buy, but it's make this product or this product. One might be more profitable, but there might be other facts involved with, I did an analysis of make A versus B. B was clear-cut winner, but then while I was doing my analysis, the sales team was doing their analysis and found out that it was for an aircraft part, but the plane was being discontinued the next year. A new model was coming out. So even though B was clear-cut winner, it didn't make sense to continue producing that part, or to start producing that part, if the plane was going to be discontinued the next year. Yeah, everybody would need to replace that part as theirs worn out, but why not make a part that was going to continue to be put on new planes as well as replace ones as they wore out? So there's always other factors that aren't the numbers on the page. So along with your question about, yeah, there could be scenarios where there are fixed costs such as lease and rent that you could get rid of, kind of like the trying to say the supervisor. You had fixed costs of supervision salaries, but they did have a way to get rid of one of them. So there's always factors beside. You can get rid of a fixed cost even though it's called a fixed cost. Okay, so discussion question 6 was asking about make a product even though it's not profitable. No, well, that could kind of tie into that. That question was kind of more, it actually could tie into a wide range of things. Whether or not there's data involved, why do you think a company would continue doing this? Why do they put milk at the back of the stores when they know milk is a product that I'm not going to say every person because I don't buy milk, but 90% of the people who are going to go in the store are going to buy milk. Milk is at the back of the stores because it's going to attract people to go buy other things in between point A and point B. But also milk and eggs happen to be one of the top loss leaders. Because if they go in to buy milk, they're going to buy products between milk and the register, or between the door and milk. So milk might be a loss leader, but their hope is that they're going to buy those cookies, the cereal, the candy, the meat on sale, whatever other products they see as they're walking through the store to buy the gallon of milk. Then there's the complementary pack products that the razor blades, they sell at a loss because that particular brand of razor blade for the Bic razor fits on the Bic number 3 razor that has a pretty nice markup. So if we keep selling these real cheap razor blades, but it went on this Bic razor, then we can make a profit on it, and those razors are going to eventually wear out. So, every week they buy these razor blades, and we're kind of giving them away, but let's say every 6 months they have to buy this expensive razor. So, okay, we'll give them a little something for them to buy something more expensive. And so there's different reasons or different items they have the loss leaders on, and so some people think it's just wrong. Everything should just have the 2% profit. And grocery stores usually have an average of 1 to 1.5% profit on average. So they have the loss leaders and they have items that are over that. So the average is 1 to 1.5%. So people think everything should have that. Well, produce items have a much higher percentage profit because they throw away so much. And sometimes you have some loss leaders attached to your produce because they're going to buy produce. Trying to think of something, and I know there's some things, but I can't say them right now. Like strawberries. When strawberries in season, strawberries are still very high markup, but then they'll sell the little shortcakes. Sometimes they'll sell them either very low or no margin. And just different items like that, just, that complement each other. So it's kind of, what's your opinion on, does it make sense for a company to do that, to sell something at a loss in hopes that they sell the other item to make more profit, or sell the milk and the eggs at a loss because they think they got you in the door and you're going to go off your shopping list? You're not like my husband. If he has a list with 5 things, he's going to come home with 5 things. Me, if I have a list with 5 things, I'd probably come home with 10. So the store's counting on me. And then, as we mentioned, the other loss leaders, I think most people understand is, end of season, when they have 10 Christmas trees left and it's January 10th, they sell them at a loss just to get them off the shelf so they can bring in the Valentine's Day candy. That kind of makes sense because you're not going to have your Christmas trees sitting on the shelf come March still at full price. I don't think that kind of thing's very debatable, and we all know, you don't have storage, infinite numbers storage shelves to save stuff for next year. So I think the question's more, what do you think about having those loss leader items that are profitable? It's not, I don't think, directed more towards the manufacturing decisions. So does that kind of clear it up? I mean, you can actually take it as what, okay. You can actually take it, it's a discussion question. You can take it to whatever direction you want, because the chapter does cover make versus buy. This was the question, was more towards the loss leaders, but you can bring up your make versus buy perspective and engage conversation that way, discussion that way. It's just, these are the discussion questions, so you can bring it up. And when I'm grading these, usually, unless you started talking about green beans being grown in fertilizer, I'm not going to count you wrong for content. You lose points for not participating, and that type of thing. When you're showing that you understand the concepts and you're wanting to go, you're engaging, then go a direction that stays with subject matter, but try to engage in a conversation however direction you want to take it. I hate this answer, but I'm not, the material, I'm not quite sure whether that material was in 6 or 7 or 8, but like I said, just it's how you interpret the question. And since we're covering both chapters in this unit, if you want to even take it, say, well, I know it's covering loss leaders, but I also am looking at it from this perspective as well. A company even though they might be more profitable going this direction, I could see why they would do this. So, as you know, take it as you want, and you could actually get more since you have eight learners answering the same question, and a lot of times you're answering with the same answer. Take it whichever direction you want. So I'll leave you with that. So we can, you know, call it a night. And if you have more questions, I'm saying this, you know, truly, please email me if you have questions. And I guess you have. You can text me, and you know, if you just don't want to call me, because I know people are like, I don't want to interrupt you. You know, text me and say, hey, I have a question. Can you call me? Or better yet, you know, I have a question about make versus buy. Can you give me a call? So that way, I at least, you know, even halfway can change gears from what I'm doing and know what I'm going to be questioned on. Because, you know, if I'm giving my dog a bath and, you know, I'm then go to give somebody a call, sometimes it's like, okay, I guess I'm getting old and don't shift gears to subjects that fast anymore or something. So you can just, you know, give me a text or something and let me know. Yes, I believe, I know when you sign into Zoom, it should ask you if you want to sign in with your computer for audio or just, or use your computer. And if you want, we could do a trial session before the next live session. You know, I could just like schedule it, you know, Saturday morning or Monday night or whatever. Just sort of a time that worked for both of us, and we could see if it worked for you. So I know when I log in, it does ask me, do I want to use computer or phone for audio? So that's fine. You know, especially it's just two of us. It wasn't like Damon sitting overseas in Afghanistan or wherever he is. I guess he can't tell me where, but he's over there. So it wasn't like he was sitting online too and a bunch of people. It's just me. That's fine. I just rather you get set up and ready to go. So if you want to test it sometime. Yeah, that works. Email works most, you know, I understand. You know, sometimes, you know, if it's something we need to talk through, we can do that too. You know, if the email's not working, then we could, you know, go from there. So why don't we go ahead and call it a night? I know you've got lots of things to do, so hopefully you are not in the path of the hail. Fortunately, we avoided it, but I heard it was kind of nasty. So have a good night and have a good week. Oh, okay. I hope you didn't have too much damage. So good night.